So in this chapter we'll be discussing about securitization in a lot more detail. Okay, in the background of subprime crisis. We discussed subprime crisis in an earlier chapter, but then we didn't know about securitization. But now that we know securitization, let us revisit it in the background of securitization. So as we discussed earlier, following the dot-com bubble and the economic trauma, the terrorist attacks 9/11, Federal Reserve has stimulated the US economy by cutting interest rates to very low levels. So due to this, the housing market has soared. There are a lot of people taking housing loan in this period, and many lenders offered home loans to people even though they had poor credit rating. So when the real estate burst, many borrowers are unable to make payments on the subprime mortgages. We discussed what is subprime. This is a subprime is the classification where the borrowers have low credit rating, and these subprime loans carry more risk and more interest rate usually in usual times. But because of this stimulating of the US economy, they were available at lower rates. But when the good times ended, the rates were reset and people are unable to repay the loans. Okay, so during that period of good times and of low interest rates, lenders gave loans to people even though who couldn't qualify in a normal case. People with weak credit history were granted loans. And now comes the concept of securitization. The investment firms were eager to buy these loans and repackage them as mortgage-backed securities. Okay, so even when they were low credit rated, people were willing to buy them because the environment was good. Okay, and many subprime mortgages were adjustable rates. So initially they were affordable, but once they were reset to a higher rate of interest, that sudden spike in payments, that was the major route for starting of the defaults, starting in 2007 and peaking around 2009. So that resulted in a severe recession that followed, and it resulted in a number of banks going bankrupt, and there was a lot of losses for number of investment firms on the Wall Street and hedge funds. Those who have invested heavily in this risky mortgage-backed securities, which we discussed in the chapter on securitization. That was one of the major factors to that contributed to the global recession that followed subsequent to 2008 and 9. Okay, so in the wake of that subprime meltdown, many sources have received blame. So this included the mortgage brokers, investment firms who offered loans to people who are of low credit rating, even credit rating agencies. Okay, so were at fault, who are overly optimistic about the non-traditional loan. So in this chapter, the questions need to prepare what are subprime loans and what role did the mortgage-backed securities play in the subprime crisis.